We're not seeing any major moves in gold or silver. The question is why? Either there isn't going to be a rally in the next few weeks and we have a new lower low to make, a new bottom to make, or the professionals, the bullion banks, are stuck and they can't get out of their shorts for whatever reason. Now, if I were a bank, I wouldn't mess with what could turn out to be World War III, because as much as banks know, they don't know everything. And when these unstable situations, these black swan events hit the newsreel, no bank knows what is going to happen. So why didn't they cover? Maybe because they can't.
In a recent video, Rafi Farber of the Endgame Investor offers a thought-provoking perspective on the correlation between global conflicts and precious metals. Farber suggests that in times of crisis, the age-old adage, when all else fails, take them to war, appears in the play. With growing concerns about the national debt, which has surged by over $500 billion in just 3 weeks, significant geopolitical developments may be on the horizon. One of the intriguing aspects of the current situation is the limited response of gold and silver prices to the ongoing conflict between Israel and Hamas. Despite the uncertainties and potential consequences associated with the conflict, gold and silver have not exhibited the expected surge in value. In contrast to this, history offers a contrasting narrative. Past global events, such as the United States moving away from the gold standard in 1933 and the post-9/11 era, saw substantial increases in gold prices. Similarly, the mere rumor of U.S. intervention in Syria in 2014 notably impacted gold prices. History reveals significant price surges in gold during critical years like 1977, 1978, and 1979, with a remarkable 126% increase during the latter year. Rafi Farber presents the chart by Daniel Oliver that underscores the tendency for commodity prices to rise during times of war. This leads Farber to suggest that a significant conflict in Israel could trigger a sudden upsurge in gold prices. In 1933, the U.S. left the gold standard, contrary to the commonly believed year of 1971. The move was prompted by economic turmoil during the Great Depression, and it allowed creditors to stop demanding gold as payment. This historical correction by Rafi Farber highlights the Federal Reserve's continuing gold reserves, which could have future significance in monetary decisions. Before diving into Rafi Farber's interview, subscribe to our channel and give this video a big thumbs up.
Go into a chart. This is actually from 2017 from Daniel Oliver's of Mermacan Capital, his chart from a research paper that he published in 2017. It gives a very good idea of the fakeness of inflation and where prices are really going in terms of real money. This is overall commodities going back all the way to 1792, and you can see pretty much where we went off the gold standard. The interesting thing is that it's not really 1971. It was really 1933. This point right here is where FDR stole all the gold in the country and put it in Fort Knox and gave certificates of that gold to the Federal Reserve System, which it still holds to this day at 11 billion something dollars at $42.22 an ounce. That is going to be revalued soon, and when it is, that will be the end game. You see here, since 1792, whenever there is a war, there is higher commodity prices. And here in 1933, when gold was revalued from 21 to 35, that is when prices really went insane. This is guns and butter, the welfare, warfare, printing craziness, which is really nothing compared to today. Then here you have Greenspan, here you have Bernanke, with gold prices, with commodities and gold prices going down and down and down, and same trend going all the way back from the founding of the United States of America. So the dollar is the illusion and gold is the real free market money. And of course, silver is the main gold substitute for retail, and this is why it is the public's, because we have gold stocks up on the Huey index 1, 2, 3, 4, 5 days in a row, and it looks like this will be 6 days in a row if we close positively today, and that is generally considered a trend change. Not all the time, but usually. So the level we're watching is to see if the Huey, the gold stock index, can top this level of 232.12. We are now at 217.71. If it does, the technical traders, or a lot of the different schools, the Elliott traders and the market historians and the cycle traders, will flood into the market at this level from what I'm seeing. And I do scour the newsletters from time to time. Gold Fields. Now, this is one stock. We're seeing already some of the gold stocks. One of them is Gold Fields, and this is a more volatile one. I'm sorry, I'm going into gold more specifically than silver this week. Gold Fields is already above its recent high of, I think, around late August, August 27th, 28th, 29th, it looks like. It's already surpassed that. So you already have some of the gold stocks making new higher highs. This is a very bullish sign that we are at the beginning of a runaway move. I was thinking, if there is a massive attack on Israel by Hamas, and it results in 1,300 dead, and this is hard to talk about, and then you have an aircraft carrier on the way to Jerusalem, who wouldn't cover their gold shorts if they were short? I write here, if I was short gold, and that news came out, the greatest massacre in the history of the modern state of Israel, with aircraft carriers on the way to Jerusalem, I would consider myself a very lucky man to be able to cover those gold shorts. But they're not. They are still short. We're not seeing any major moves in gold or silver. The question is why? Either there isn't going to be a rally in the next few weeks and we have a new lower low to make, a new bottom to make, or the professionals, the bullion banks, are stuck and they can't get out of their shorts for whatever reason. Now, if I were a bank, I wouldn't mess with what could turn out to be World War III, because as much as banks know, they don't know everything. And when these unstable situations, these black swan events hit the newsreel, no bank knows what is going to happen. So why didn't they cover? Maybe because they can't. And if they can't, the bullion banks are going to be stuck for good. If they can't get out now, they can't get out ever unless they take severe losses.
Fortuna Silver Mines recently reported an impressive performance in the third quarter of 2023. Their gold production reached a record 94,821 ounces, with silver production totaling 1,680,751 ounces. The gold output saw a remarkable 43% year-over-year increase, primarily attributed to the first full quarter of production and consistent operational performance at the Séguéla mine. Farber acknowledges Fortuna Silver's adherence to its financial plan, utilizing increased cash flow from mining operations to reduce debt and enhance its financial stability. Meanwhile, the government faces a budgetary impasse with political disputes regarding the causes of escalating debt accumulation. The budget deficit, representing the disparity between government spending and revenue, has surged to $1.5 trillion over the first 11 months of the fiscal year, marking a 61% increase compared to the previous year. Farber raises concerns about the potential consequences of this mounting debt, as it could rapidly deplete the reverse repo tank, a crucial financial mechanism. Such depletion could result in banks facing a shortage of dollars and may trigger asset sales, potentially leading to a financial crisis. Let's get back to the interview.
And let's get on with this week's Silver Report. This week's Silver Report is brought to you by Fortuna Silver Mines, symbol FSM. More good news came out a few days ago. This is October 10th. Yes, this was 2 days ago. Fortuna pays down $40 million of debt from increased cash flow. Fortuna reports that it's paid down $40 million of its revolving credit facility at the end of the third quarter of 2023 using cash on hand. $133 million of net debt as of the end of the quarter. This represents a reduction of approximately $65 million in total net debt in the period, reflecting increased cash flows from the contribution of the Séguéla mine in its first full quarter of production. This was the plan all along. They spent to get Séguéla, and now that spending is over, and now the cash flow is reversing the debt into retired debt, and their debt burden is decreasing. So everything is going according to plan for Fortuna. Now, I wanted to show this little piece of insanity as another hint that we are near the very end of this monetary system, and the end game is right at the door. This chart coming up next might shock you. Now, this is two national debt tweets from National Debt on X. It goes from September 21st, which is the top one, to October 12th, the bottom one. The difference is about $550 billion. It's $70 billion less than that, but it's probably $70 billion more today. So in about 3 weeks, in 3 weeks' time, the national debt has increased by $550 billion in 3 weeks. Now, look at this. This is the Treasury's account at the Fed. It is up only $62 billion in the same time frame. If you take 550 and you take away 62, it means they have spent about $500 billion in 3 weeks. What the hell is going on? What are they spending it on? Well, World War III looks like it might break out soon, so I don't know. Take your guess. Now, this chart is what shocked me. I configured this chart on Fred, and I couldn't believe it when I saw it, but I suspected something like it would be true. This is the quarterly change in national debt. Quarters are 3 months long. Now, I drew the red line at $550 billion, where the increase in the national debt is over the last 3 weeks. Now, since 2008, everything before 2008 is much, much lower than this. This is the change in the national debt in a quarter. Now, the all-time record in 2008 was this, at about $800 billion for the whole quarter. If we count the quarters in which this $550 billion line was breached for quarters, 1, 2 in 2016 under Trump, or Q4 2015, 1, 2, 3, 4, 5, COVID lockdowns, 6, 7, 8. 8 quarters. Those were the only quarters that exceeded the 3-week increase in the national debt, the last 3 weeks. What the hell is going on? You can't increase the national debt $500 billion every 3 weeks. This is going to empty the reverse repo tank very quickly. We are down to about $1.2 trillion on that reverse repo tank, and that is the reserve dollar tank. After that is emptied, the banks that are short dollars are going to have to sell assets to maintain their debt service. Once that reverse repo tank gets empty, we're going to have the final financial crisis.
Why are gold and silver not responding as expected? And what does this suggest about the contemporary dynamics of precious metals in times of crisis? What do you think? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being part of our community.